It's April 2021, and in our Discord, a trader I'll call Dan posts a chart of Peloton. Price had already been sliding for weeks. He typed, "This is a steal. Look at the discount." His plan was simple: buy a fallen star and ride it back to glory. But quarterly earnings had stalled. But sales growth had slowed for 2 straight quarters. But the chart was under its 200-day moving average, with every rally sold into hard. He added more when it dipped further. He told himself it can't go much lower. What he didn't see, or didn't want to see, was the absence of every O'Neill hallmark. No strong earnings, no accelerating sales, no tight base under accumulation, no relative strength in the top tier. Weeks later, Peloton was nearly cut in half. If we'd applied the actual O'Neill screening process that day, the trade wouldn't have even made it past step 1. That's why in this episode, I'm going to walk you through exactly how O'Neill finds leaders. My name is Ben, and welcome to Zen Stock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. The first time I picked up How to Make Money in Stocks by Bill O'Neill, it didn't just give me a strategy, it rewired my entire view of the market. O'Neill isn't just another market author. In my own trading, he's the most influential figure I've ever studied. When I say his work changed everything, I mean it. I stopped chasing cheap stocks and started hunting leaders. His method is elegant, demands strong current quarterly earnings, accelerating sales, leadership within a leading industry group, and a clean technical base ready to break out on heavy volume. Once you see it, you can't unsee it. It's like moving from fuzzy X-rays to high-resolution MRI. The market structure is suddenly visible. Same rhythm. Same emphasis on new highs over cheap pullbacks. Same discipline about waiting for volume to confirm the move. It's not theory, it's process. And that process works. I learned this the hard way in 2014. I bought a stock because it was famous and down from its highs. I told myself the brand was strong and the price had to recover. But quarterly earnings were flat. Sales growth was slipping. The group was lagging the market. I watched it grind lower, thinking I was being patient, but I was really just clinging to a bad decision. A year later, I ran into a completely different setup. It was a newer company with a breakthrough product. Earnings up over 70% in the last quarter. Sales accelerating for 3 straight quarters. Relative strength rating over 90. The base was tight, with closes clustered in a narrow range, exactly the kind of price action O'Neill taught signals accumulation. I didn't guess. I waited for the breakout. When it came, volume was more than 50% above average before lunch. I bought with a stop just below the pivot. No drama, no hope. Just a blueprint I could follow. That stock ran hard, pulled back to the 10-week line, held it, then took off again. And the biggest change for me wasn't just the gain, it was the calm. I wasn't reacting, I was executing. In our Discord, I've watched the same shift. When someone tosses out, "this looks cheap play," the room pushes back. What's the EPS growth? What's the sales growth? Is it even in a leading group? We've built a culture of scanning for strength, not stories, and that's straight out of O'Neill's playbook. So here's the focus for today. We're going to strip away all the noise, the hot takes, the value traps, the social media hype, and break down how William O'Neill actually finds the market's biggest winners before they become household names. We're not just talking theory. I'm going to walk you through the same checklists I use in my own scans, the same earnings and sales thresholds, the same technical patterns, the same volume tells. This is the process that turned my trading from reactive to deliberate. But I need to be clear, this isn't about predicting the future. O'Neill's entire system is about aligning with current evidence, what the price and volume, earnings and sales are saying right now. We're not fortune tellers, we're evidence collectors, and when the evidence lines up, we act with conviction. And just to be absolutely clear, this is for education and entertainment. I'm not telling you what to buy or sell. I'm showing you a process you can test and adapt for yourself. The market has risk. No system wins all the time. Your job is to learn the rules, apply them consistently, and manage your risk. If I had to sum up O'Neill's stock-finding philosophy in one sentence, it would be this. Finding the next market leader is like scouting an Olympic athlete 2 years before the Games. You're looking for elite performance now, in the right competitive field, with signs they're about to peak on the biggest stage. It's not about rescuing someone who was once great but is now injured. It's not about betting on the underdog just because it feels good. It's about spotting the player already breaking records in practice, surrounded by a winning team, with the world just starting to notice. In market terms, that means explosive current earnings. It means accelerating sales. It means leadership in a leading group. It means a clean technical base, showing tight action and accumulation, ready to break into new highs on volume that screams demand. When you see all of that in one place, that's when you step up to the plate. Not because you hope it will work, but because the evidence says it has the best shot of any trade on your list. O'Neill says that in the biggest winners of the past 50 years, 3 out of 4 showed earnings growth averaging more than 70% in the latest publicly reported quarter before their huge runs. That's not an opinion, that's from his study of over 600 market leaders. When I first read that, it felt almost too simple. You're telling me the first filter for a stock is it making a lot more money than it did this time last year? Yes, because that surge in earnings isn't just a number, it's proof the business is firing on all cylinders. It means customers want more, margins are healthy, and management is executing. The psychological side? When you only buy stocks with huge current earnings growth, you take away one of the most dangerous rationalizations. It's down, but maybe it'll turn around. You stop buying on hope and start buying on performance. In our Discord, this one rule alone has killed countless bad trades before they even start. A member once dropped a chart of a favorite retailer, beautiful store, great brand. We pulled up the quarterly EPS, flat for 2 quarters, down in the most recent one. That was it, no trade. It saved them from a slow bleed that took 40% off the stock over the next 6 months. Joe Farmy, a well-known trader, drives this point home constantly. He'll scroll through his watch list, and if the earnings aren't there, he just says, pass. No emotion, no attachment. Because the first gatekeeper doesn't care about your opinion. Earnings can be manipulated with accounting. Sales are harder to fake. O'Neill looked for at least 25% sales growth in the latest quarter, or clear acceleration over the last 3 quarters. Why does this resonate with me? Because I've lived through the earnings pop that fizzles when revenue can't keep up. You get 1 or 2 quarters of great EPS thanks to cost-cutting or a one-time boost, but without sales growth, it's like a sprinter running on fumes. Psychologically, sales growth keeps you confident after you buy. When the market shakes out weak hands, knowing the company is truly growing makes it easier to sit tight on a normal pullback. One of the cleanest examples I've seen came in 2020 with a cloud software stock. EPS up 80%. Sales growth accelerating from 25% to 30% to 40%. The chart formed a tight 3-week shelf, and Joe Farmy highlighted it in his weekend list. Breakout volume was massive, and the stock doubled in under a year. Without the sales acceleration, I might have skipped it, and that's the point. Strong sales confirm the earnings aren't a fluke. O'Neill hammered this. The best stocks are usually the S1 or S2 in their industry group, and that group is itself leading the market. He compared it to betting on the fastest horse in the fastest race. When I started tracking this, it changed everything. I stopped wasting time on lonely standouts in weak groups. The psychological trap here is the outlier bias. We love the idea of finding the one stock that will defy its sector. But in reality, money flows to groups. Funds buy baskets of leaders in hot sectors, and that tide lifts them together. In our Discord, we now track industry group strength weekly. If a stock idea comes up but its group is lagging in relative strength, it gets a yellow flag. If the group is in the top 20% of the market and the stock is a clear leader in that group, that's when we pay attention. I've watched Joe Farmy structure his lists this way too. He doesn't just pick stocks in isolation, he builds clusters. When semiconductors are leading, his list is full of the top chip names. When software is leading, he's got the best 2 or 3 in that space. This isn't just chart reading, it's understanding market structure. O'Neill's studies found that almost every huge winner broke out from a sound-based pattern, often a cut with handle, flat base or double bottom, with tight weekly closes before the move. This was a game changer for me. Before O'Neill, I'd buy on gut feeling, usually after a run, thinking I'll ride the momentum. The problem is, without a base, you don't have a clear entry, and without a clear entry, you don't have defined risk. Psychologically, having a base as your roadmap reduces stress. You know exactly where you're wrong. If price falls back into the lower part of the base on heavy volume, you're out. No debate. We had a textbook example in Discord last year with the cybersecurity stock. 6-week flat base. Volume dried up in the last 2 weeks. Breakout day? Volume 60% above average. That trade worked because we didn't guess. We waited for the base to finish the story before acting. O'Neill was clear. On breakout day, volume should be at least 40% to 50% above average. That's not just a nice to have, it's proof that institutions are buying. And institutions are the only players with the firepower to drive multi-month moves. When I first applied this, I realized how many breakouts I had been buying without real demand behind them. They'd drift higher for a few days and then fail because the big money wasn't there. Psychologically, this rule gives you confidence at the moment of execution. When you see that volume spike as price clears the pivot, you know you're not alone, you're moving with size. In our Discord, we've turned this into a hard rule: no heavy volume, no trade. A few months back, we skipped a tempting breakout in a hot AI stock because volume was only 10% above average. It failed within a week. No trades saved us money. That's the full stock-finding skeleton O'Neill left us. Big current quarterly earnings. Accelerating sales. Leadership in a leading group. A sound-based pattern. Breakout volume confirmation. When you stack these together, you're not guessing. You're running a process that's pulled from the DNA of past market champions. When O'Neill published his studies of the 600 biggest winners from 1952 to 2001, he wasn't just cherry-picking a handful of trades. He looked at decades of market history, bull markets, bear markets, sideways grinds, and asked a simple question: what did the winners have in common before they made their biggest moves? The answer wasn't low PE. It wasn't big dividends. It wasn't cheap compared to book value. It was the combination we just walked through: big current earnings. Accelerating sales. Leadership in a strong group. A sound base. Volume confirmation at the pivot. Look at Home Depot in 1981. IPO at 12. 2 years later, up more than 20-fold. Why? Triple-digit earnings growth. Sales climbing quarter after quarter. It was the clear leader in the booming home improvement sector. And the chart? A beautiful, well-formed base before each major leg. O'Neill didn't just show the chart, he marked the exact pivot points, the exact volume spikes. Same with Cisco in the early 90s. It didn't look cheap on a PE basis. In fact, it looked expensive. But quarterly earnings were exploding. Sales were compounding. And every breakout came with massive volume bursts that confirmed institutional sponsorship. In 2020, one of our Discord traders brought up a new IPO in the cloud software space. At first glance, it looked too high. The IPO base was forming near the upper end of its range. But when we ran the checklist, it was textbook O'Neill, quarterly EPS growth of plus 120%. Sales up 55%, accelerating from the prior quarter's 45%. Industry group ranked in the top 10%. Tight closes for 3 weeks before the pivot. Breakout day volume up 70% above average. That stock doubled in under 12 months. Not because we guessed, but because the evidence matched the profile. There's a fascinating study from Barbaris and Thaler, 2003. On investor behavior, they found that humans systematically underreact to new information in the early stages of a trend. Earnings blowouts and sales acceleration often don't get fully priced in right away, especially when the stock is already expensive. This lag is exactly what O'Neill's method exploits. By identifying leaders as they emerge, you capture the run before the crowd fully catches on. That's why buy high, sell higher works. When the fundamentals and technicals align, you're not chasing, you're aligning with early institutional demand. I've sat in on Joe Farmi's weekend sessions, where he scrolls through dozens of charts in minutes. What he's doing looks fast, but it's actually just deeply ingrained pattern recognition from years of running the same O'Neill filters. He'll see a chart, note the earnings growth, sales trend, industry group rank, and base structure almost instantly. When something's missing, it's a quick pass. When it's all there, he marks it and watches for the volume confirmation. The psychology here is powerful. Because he knows exactly what he's looking for, there's no hesitation when the setup appears. That decisiveness is what most retail traders lack. They second-guess, overthink, and miss the moment. When you adopt a stock-finding process this precise, you remove so much mental noise. You stop feeling like every stock in the news is a potential trade. You stop worrying about catching the exact bottom. You stop reacting to random headlines. Instead, you know that until those 5 conditions line up, it's not your trade. And when they do line up, you act, not out of hope, but out of statistical evidence. One of the hidden strengths of O'Neill's stock-finding method is that it doesn't just tell you what to buy, it quietly protects you from some of the nastiest psychological traps in trading. From my own trades, the traders I've coached, and our Discord history, I see the same patterns repeat over and over. Here are 3 of the biggest, and how O'Neill's process blocks them before they can do damage. Trap 1. The cheap stock illusion, anchoring bias. You see a stock that was once 200 now trading at 80. Your brain locks onto that old high and starts whispering, it's bound to go back there. That's anchoring bias, tying your expectations to an irrelevant past price. We had this happen in Discord with a well-known fitness brand in 2021. Once a darling during the pandemic, it fell over 50% from its peak. A few traders jumped in because it's half off. But O'Neill's checklist would have thrown it out instantly. Earnings growth was negative. Sales were declining. The group was lagging. The chart was wide and loose, not tight into a pivot. Following the process keeps you from romanticizing a stock's former glory. Instead, you look at what it's doing now. Trap 2. The story over stats error. Confirmation bias. We love a good story. A charismatic CEO. A breakthrough product. A brand we use every day. Once we're sold on the story, our brains look for evidence to confirm it and filter out anything that contradicts it. In 2020, a trader in our group was obsessed with a certain electric vehicle startup. The prototypes looked incredible. The CEO was all over the news. They ignored the fact that revenue was minimal and earnings were deeply negative. O'Neill's method breaks this spell. When you force yourself to check EPS growth, sales acceleration, industry group rank, and volume patterns, it's hard to keep believing in a fairy tale. The checklist has no patience for maybe someday, it only cares about right now performance. Trap 3. The low volume breakout, process versus outcome. Confusion. One of the most frustrating things in trading is seeing a stock breakout without volume and then it runs anyway. You start thinking, maybe the volume rule is too strict. That's process versus outcome confusion, abandoning a proven rule because of one exception. I've been there. I've chased a low volume breakout, thinking I'd outsmart the system. More often than not, those trades fizzled, because the lack of institutional demand showed up later. In our Discord last year, an AI stock broke out with only a 15% volume increase over average. Some members jumped in. By the end of the week, it was back in the base. The ones who waited for the 40 to 50% surge saved themselves a stop out. O'Neill's method builds discipline by giving you clear, data-backed thresholds. When you see volume explode at the pivot, you're not guessing. When you don't, you pass, and that patience pays over the long run. Most traders blow up not because they lack intelligence, but because they let these traps dictate their entries. By filtering every idea through O'Neill's 5-part process, you sidestep the emotional hooks before they sink in. You stop falling in love with stories, you stop anchoring to old highs, and you stop breaking your own rules just to feel like you're in the game. The beauty of O'Neill's approach is that it's not just philosophy, it's executable. Here are 2 tools pulled directly from his method that you can apply today to start finding higher quality trades and avoiding the noise. This is my adaptation of the core CAN-SLIM criteria into a quick pre-flight check before I buy. I keep it written down, not because I don't remember it, but because the act of checking each box keeps me disciplined. The 5 questions. Earnings growth. Is the latest quarterly EPS up at least 25 to 50% year over year? Sales growth. Are sales up at least 25%, or clearly accelerating over the last 2 to 3 quarters. Industry leadership. Is this one of the top 1 to 2 names in a top-performing industry group? Base pattern. Is the chart forming a sound base with tight closes into the pivot? Volume confirmation. Is breakout volume projected to be 40 to 50% above average? If I can't answer yes to all 5, I don't take the trade. That's simple. Why it works psychologically. It removes the temptation to bend rules in the heat of the moment. You're not deciding whether to buy based on excitement. You're checking if the evidence is complete. In Discord, we've even turned this into a shared habit. When someone posts a chart, others will literally reply with checklist. It's become a filter we all apply in seconds. O'Neill's system isn't just about buying right, it's about selling wrong quickly. One of his simplest but most powerful ideas: sell if the stock gives you 2 clear violations of expected behavior. My version of this, strike 1, closes below the 10-week moving average on above average volume without quick recovery. Strike 2, fails to make progress after a breakout, with multiple distribution days, heavy volume down days in a short span. Once I get 2 strikes, I'm out, even if the loss is small or the trade is flat. Why it works psychologically: it creates a mechanical exit that prevents the "I'll just give it one more day" spiral. By defining in advance what constitutes bad behavior, you don't have to negotiate with yourself while the stock is sinking. O'Neill's genius wasn't in predicting which company would become the next Apple or Amazon. It was in building a repeatable framework that kept you in sync with market leaders while protecting you from your own impulses. These tools, the 5-point pre-buy checklist and the 2-strike sell discipline, are just 2 ways to operationalize that genius in your own trading. Before we wrap, I want to turn the lens back on you. Because O'Neill's process isn't just a set of rules, it's a mirror. It will show you, very quickly, whether you're a disciplined trader or a hopeful speculator. So here's a quick self-audit. Don't overthink it, just answer honestly and see where the gaps are. Question 1. Do you buy on evidence or on feeling? Think about your last 3 trades. Did you buy because the chart and fundamentals lined up perfectly? Or because it looked cheap, you liked the story, or someone on Twitter was hyping it? If it's the latter, you're letting emotion run the show, and the market will happily punish you for it. Question 2. Do you have a written pre-buy checklist? Not a mental one. Not, "I know what I'm looking for." A written, literal checklist you run every trade through before you click buy. If you don't, you're relying on memory, and memory is vulnerable to FOMO, confirmation bias, and selective blindness when you really want to own something. Question 3. How often do you violate your own sell rules? Be brutally honest. Have you ever moved a stop just to give it a little more room? Held a stock through 2 or 3 obvious signs of institutional selling? If so, you're paying tuition to the market for not sticking to your own terms. Question 4. Do you know your last 10 trades win rate and average gain-loss? O'Neill knew his stats cold. If you can't answer this without checking your broker's history, you're not tracking your edge. You can't improve what you don't measure. Why this matters: self assessment forces you to confront the difference between knowing the rules and living the rules. In our Discord, I've watched traders transform not because they learn something new every week, but because they committed to actually applying the same high-probability process over and over. William O'Neill didn't just write a book. He built a framework that rewires how you see the market. Once you've run a few hundred charts through his process, it stops feeling like rules and starts feeling like eyesight. You can't not notice when earnings are surging. You can't not notice when sales are accelerating. You can't not notice when a base is tight and volume explodes at the pivot. That's the gold. It's not about predicting the next Tesla or Amazon. It's about being ready when the real leaders reveal themselves. For me, O'Neill is the most influential trading mind I've ever studied. Markets change, tickers change, but the DNA of winning stocks hasn't. We've built a culture around this. We don't chase cheap, we don't fall in love with stories, we don't skip the checklist. We wait for the evidence, and when it's there, we act with confidence. Your next step: print the 5-point pre-buy checklist. Run it against every idea you have this week. When something fails the list, pass without regret. When something passes, watch it like a hawk and be ready to act when volume confirms. This isn't about catching every move, it's about catching the right moves, the ones that fit the profile of past market champions. O'Neill proved that you don't need to predict the future to win in the market, you just need to recognize when the present matches the conditions of past success. That recognition is your edge. Protect it, refine it, and never trade without it. Now, here's my challenge to you. Write down the single biggest takeaway you got from this video in the comments. Share it with a friend who's been struggling with their trading. And if you found this useful, like, share, and subscribe. Every trader you've ever admired had to master these same principles. And the sooner you make them part of your own process, the sooner you trade without fear of the next big loss. Master your mind. Master the market. Trade with confidence and live with calm.